Good afternoon and welcome to the first Investor Education webinar hosted by the Trinidad and Tobago Securities and Exchange Commission. Before we get started, I would like to state that we are not here to tell you where you should invest or how to make more money, but rather we are here to ensure that you understand what information you need in order to make sound investment decisions and what your rights and responsibilities are as a consumer of financial services. The Trinidad and Tobago Securities and Exchange Commission, or TTSEC, is the sole regulator of the nation's capital market. This includes the market for stocks, bonds, mutual funds, etc. Our fellow regulator in the financial services sector is the Central Bank of Trinidad and Tobago, which regulates the banking and insurance sectors. Both entities report to the Minister of Finance. The Trinidad and Tobago Securities and Exchange Commission is the regulatory body mandated to look after the interests of investors in Trinidad and Tobago. We protect you by registering all persons who deal in securities. Check the list of registrants on our website, www.ttsec.org.tt, before engaging in any securities transactions. Ensuring that all of the information about the security that an investor would need in order to make an informed decision is disclosed, both to the Commission and to potential investors by the market participant. We conduct routine market surveillance and investigate possible breaches of the Act, as well as customer complaints against registered market actors. The Commission enforces rules through the use of orders, guidelines, and bylaws, and we also conduct a multimedia investor education program designed to provide investors and potential investors with suitable information to guide informed decisions. Here's what we also do.
The Trinidad and Tobago Securities and Exchange Commission, TTSEC, regulates the securities market in Trinidad and Tobago and the persons and entities that operate in it. These include the stock exchange, brokers, dealers, investment advisors, and institutional investors. Want more information on the securities market or the TTSEC? Visit www.ttsec.org.tt or call 624-2991.
Now let's see if you can answer this question correctly. What does the TTSEC regulate? Banks, insurance companies, the securities market, credit unions. Do you fully understand what we mean when we use the term security? A security is an investment instrument that has a value and can be traded or transferred. Some examples of securities include stocks or shares, mutual funds, bonds, and treasury bills. Most people are not content with the salary that they receive, especially as the cost of living continues to increase at a faster rate than their salary does. Therefore, it is important that persons save or invest for a rainy day. Here are some reasons why persons save or invest: to manage their money and cope with unexpected expenses and emergencies, to afford things they need in the future, to borrow less, to ease financial stress, and to cater for retirement. To emphasize the importance of beginning to save or invest from an early age, we will use this calculator. Let's say you're 20 years old and you decide to put a lump sum payment of $5,000 into a financial instrument that gives a 3% return. In addition, you will pay $1,500 a month until retirement at age 60. Assuming that you don't take out the money and you allow the wonders of compound interest to work, at retirement you would have saved $1,359,950.87. If, however, you don't make that decision until you reach the age of 30, at retirement, you will only have $853,781.20. And remember, inflation will also whittle away at these figures, so the earlier you start, the more you will have when you need it most. Now, many persons use the term saving and investing interchangeably. However, at the TTSEC, we make a distinction between the two. The term savings refers to money that is put away regularly to pay for expensive items, for example, a holiday, furniture, or a special occasion. It can be short or long-term and generally attracts a minimal rate of return. The money earns interest, usually quarterly or yearly, with little risk of loss. The risk is usually based on changes in interest rates, and the money can be retrieved immediately or after the requisite notification period. Investments, on the other hand, are generally long-term, 5 years and over. Your money is invested in assets whose values can rise or fall. Of extreme importance is the fact that the greater the opportunity to get high returns, the greater the risk. And there is no guarantee that you will get an increased return or even recover your original investment. After hearing our definitions of the two, we have a poll question for you. Do you consider yourself to be an investor? Yes or no? People save or invest to meet different goals. In a previous slide, I mentioned the word risk. But what does risk mean? Simply put, risk is the degree of uncertainty about the return an investor would earn on an investment. This means that there is a possibility of an investor incurring a loss on his or her investments. Remember, the higher the return, the higher the risk. That higher return is your compensation for taking on the additional risk. Before I move on, consider whether you are a risk taker or not. I trust that by now you are convinced that you should either save or invest money to take care of your future needs. But before you rush off to get started, here are 3 steps that we advise you to take. Step 1. Establish your investment goals. This is where you do some introspection to determine what you would like to achieve in the next 3, 5, 10 years and beyond. Step 2. Determine your risk tolerance. You need to know how risk affects you. Would you panic if the value of your investments took a dip? Or would you ride out the storm knowing that what goes down must come up? Generally, younger investors are more risk takers since they have the age-time horizon on their side to recoup from losses. More mature investors generally tend to be risk-averse since they don't want to risk all that they have worked hard for all their lives going down the drain. Step 3. Create your intended portfolio mix. Smart investors try to have a mixed portfolio of high and low risk type investment instruments to balance each other off. If they take a hit in the riskier instruments, they are bolstered by the regularly performing ones, although they give lower returns. We will now explain the 4 main classes of investment products which you can use to increase your wealth. 1. Real estate. This includes land and buildings. The value of these tend to appreciate over time. 2. Equity. This is the share in ownership of a company. You may be more familiar with the term stocks. Stakeholders benefit from dividends based on the stock's performance in a financial year. You can consider it a share of the profits when a company does well. Owners or shareholders also can receive capital gains based on the upward movement of the stock's share value. Here's an example to help you better understand capital gains. Let's say you bought stock X in 2008 for $40 per share. Despite the ups and downs of the market, the stock price in 2013 has risen to $85 per share. This means if you had bought 1,000 shares in 2008, you would have spent $40,000 to obtain those shares. In 2013, those same shares would have appreciated in value and are now worth $85,000. Therefore, if you were to sell your shares at this point, you would have made a capital gain or profit of $45,000. The following charts depict the performance of 3 securities traded on the Trinidad and Tobago Stock Exchange. The first 2 are for over the period January 2012 to January 2013. The last one shows a 5-year time frame. As we review each chart, one thing that will be immediately noticeable is the difference in performance of these securities, which is reflected in the different shape of each graph and which demonstrates a major feature of the securities market, its volatility, and by extension, the varying level of risk involved. The sudden rises and falls in the price of a security depend on many variables and will affect the returns achieved on these investments. The upper portion of the chart shows the price of the security. In this first chart, it can be seen that there's a general increase in price of the security over the year. And there were also some sharp rises in late October and December 2012, as well as January 2013. This second chart shows a more volatile security where there are marked fluctuations in the price over the same period. If an investor purchased shares in the security at the start of January 2012 for about $14.50, they would have experienced an immediate capital gain shortly thereafter because of the slight increase in price to $15. But by mid-January, there was a capital loss due to the fall in the price to $14. If the investor chose to keep his or her shares for the next year, in spite of the fluctuations in the price, they would experience an overall capital gain since the price of the shares at the end of the period was $18.50, which was higher than the price at which the shares were purchased, with the price actually peaking at $20 in September 2012. The third chart shows the performance of another security over a longer period of 5 years, 2008 to 2012, and further highlights the volatile nature of the market. If an investor purchased shares in this security at the start of January 2008 at $80 per share, he would have experienced a capital gain for the greater part of that year until the price began to steadily decline nearing the end of 2008. The price leveled for much of 2009 and began once more a steady decline until late 2010, after which there was a recovery at the end of 2012 with the price per share appreciating to $110. Once more, price volatility is seen over the long term, and in some cases, an investor may choose to keep his or her investment during this time, await a recovery, and sell when the price peaks, or he or she may choose to bail out and count the losses. If the investor chose to keep his or her shares for the entire period shown in this chart, there would have been a net capital gain of approximately $30 per share, representing a very healthy return in 5 years. The story would have been different had he or she chosen to bail out sometime at the end of 2011, since there would have been a loss of approximately $15 per share. We come now to debt instruments or bonds. These are essentially a loan arrangement between the issuer of the bonds, a borrower, and the purchaser of the bonds, an investor or a lender. To show how this works, let's use this example. If the government wanted to build a new port, it could issue a bond, that is, raise funds or borrow from institutional investors such as banks and other financial institutions, as well as the general public, the lenders. And for this, the lenders will receive interest on the sum loaned. At the end of the repayment period, the lenders will have gotten back their principal as well as the interest. Bonds are usually long-term in nature and can go for up to 30 years. The agreement between the borrower and the lender should specify the duration of the bond, the rate of interest, the time of the interest payment, and the repayment of the principal. The fourth, cash and cash equivalents, are monies that you can easily walk into a financial institution and retrieve, and hopefully you don't keep under your mattress. Mutual funds are investment instruments. However, many investors who own them do not even understand what they are or how they work. Mutual funds comprise investors' funds which are pooled and invested in a combination of stocks, bonds, and other types of securities. Investment decisions are made by dedicated fund managers who manage your portfolio mix in order to match your risk profile and get the most return on your investment. Investors are therefore able to diversify their holdings so that a failure by any specific instrument does not necessarily have a devastating effect on the entire portfolio. And unskilled investors do not have to make decisions on their own about each financial instrument in which to invest, and therefore they benefit from the expertise of professional investment managers. There are some key points to remember about mutual funds, however. Unlike bank deposits, which are guaranteed or insured by the Deposit Insurance Corporation, DIC, for up to $125,000, mutual funds are not. Also, just because the funds were doing exceptionally well last year, you should not necessarily take this to mean that the same will happen for all the years to come. Don't be dazzled by last year's high returns. Remember, all mutual funds have costs that lower your investment returns. Shop around and compare the cost of owning different funds before you buy. Here's a poll question for you. What type of investment instruments do you own? Mutual funds, shares, bonds, pension plans, savings account in a bank? So what kind of investor are you? Are you a risk taker or are you risk averse? When considering what to invest in, you can divide the 4 asset classes based on risk profiles. Equity poses the highest risk. Debt has low risk. Cash is even lower risk. Real estate is the lowest risk. When considering your investment options, you must also bear in mind the following criteria. First, liquidity. If you have an emergency, how easy will it be to turn the investment into cash? Safety. How stable is the investment? What has the performance been like over the past 3 years? Has it been reduced? What rate of returns does the investment attract? Is there a tax saving incentive? Does the investor have to do anything once the investment is purchased? Is there a minimum that has to be invested? Time frame. Some investments promise a guaranteed return, that is, that you would get back at least what you put in, if it is left for a stipulated period of time. Always remember what your grandmother used to say. Don't put all your eggs in one basket. Keep your portfolio diversified with a mixture of investments with varied risk. That way, if one or more does not perform as expected, all is not lost.
Investment scams come in different shapes and forms. Here are some red flags. Guaranteed returns. No risk. Once in a lifetime deal. You can tell it's a scam if the seller tries to rush you into a decision. He tells you that other friends or relatives have already taken up the offer. He promises you guaranteed returns with no risk. Remember, if it sounds too good to be true, it usually is. For more information, visit www.ttsec.org.tt or call the Trinidad and Tobago Securities and Exchange Commission at 624-2991.
Many persons believe that they can never be taken in by a scam artist. Unfortunately, our records show just how easy it is to fall victim to a con man. I am sure almost every one of you who has email would have been bombarded with emails purporting that you have won a lottery, even though you never bought a ticket, and that you have to send personal financial information or even money to retrieve your prize. Others may claim that they need your help to get money out of a foreign bank account, and they will give you a percentage of the money once retrieved. Remember, you cannot always determine whether the information is true or false. It is difficult for you to get redress in Trinidad and Tobago when you can face the person who sold you a defective item. How much more difficult will it be to get redress when you lose money and have to try to trace the internet scammer? Have you ever heard of a pyramid scheme? This is essentially a model which involves the exchange of money and the necessity to enroll other people into the scheme, usually with no product or service being delivered. A Ponzi scheme is similar. The essential difference between a pyramid scheme and a Ponzi scheme is that a Ponzi schemer will only ask you to invest in something. You won't be asked to take any other action other than handing over your money. He or she will claim to take care of the rest and give you your returns at a later date. Elements of a pyramid scheme can include investments paying interest monthly, interest rates above market rates, programs running for defined periods, commonly 1 year or less. The promoter is usually encouraging you to roll over into the next program. Remember, any scheme that requires new investors to pay existing investors is a fraud. This diagram shows that the business model on which a pyramid scheme is premised is non-sustainable. The first tier of investors number 6 persons, who in turn have to bring in 6 more persons into the scheme. Those 36 persons also have to enroll 6 persons each, and so on. The funds brought in by each tier pays the tier above. At some point, however, persons are unable to bring in the required number of persons to complete the next tier, and the pyramid begins to totter. Newly enrolled persons get nothing. Persons who rolled over their money get nothing. And only the persons who got in early and got out, and of course the promoter, are the ones smiling all the way to the bank. The most infamous Ponzi scheme in recent times involves Bernie Madoff, who, excuse the pun, made off with persons' money. He was the former chairman of NASDAQ Stock Exchange, a former stockbroker and financial advisor. He was convicted of operating a Ponzi scheme that has been called the largest investor fraud ever committed by a single person. Prosecutors estimated the size of the fraud to be US $64.8 billion, based on the amounts in the accounts of Madoff's 4,800 clients as of November 2008. In June 2009, he was sentenced to 150 years in prison and fined US $170 billion in restitution. I'm sure many of you would have heard of Alan Stanford, who was a former prominent financier and sponsor of professional sports. He was the chairman of the now defunct Stanford Financial Group of Companies and was a citizen of Antigua and Barbuda and the United States. and contributed millions of dollars to politicians in both countries. In 2009, the US SEC charged Stanford with running a massive Ponzi scheme. In March 2012, Stanford was convicted and sentenced to 110 years in prison for perpetrating a US $7 billion Ponzi scheme that swindled 30,000 people in over 100 countries. Of course, to be sure, what happens in more established countries also happens right here in Trinidad and Tobago. Our local permit scheme involved a company called Fantasy Tours. This was essentially a tour company which was involved in a pyramid scheme. It started in November 2005, offered 3 products, paying up to 15% every 15 days. It enlisted more than 3,700 subscribers. Their total investment was approximately $43.5 million. The TTSEC became aware of the scheme when one of the members came to us after having invested because he felt a little unsure about the investment. Of course, this company was not registered with the TTSEC to do any form of business. The TTSEC had to approach the courts in the matter. An injunction was granted by court to hold trading on request of the commission, and the final recovery for investors was 53.4%, that is TT $23.2 million. So who are these conmen and who do they target? These conmen exploit the traits of others, such as their honesty or dishonesty, curiosity, vanity, kindness, capriciousness, gullibility, or simple greed. They target a new group of graduates, persons receiving back pay, retirees, among others. Their modus operandi, they eavesdrop on conversations. You'd be surprised how people talk out their business in a food court in a mall, for instance. They build on referrals from trusted friends, relatives, supervisors at work, or persons in your church group. They use confidence-instilling organizational names like Safe Holdings and Trust, Flagship Investment Company, and they impress you with a silver tongue. If you fall victim to a financial scam, inevitably all you are left with are broken promises. Don't let this be your nest egg. So how do you protect yourself as an investor? You have the right to receive information about the organization you are dealing with, as well as the persons directly in charge of your account. You should be provided in writing with information on the type of investment you are interested in and how it works, the level of risk, the projected return, past performance, the cost of investing, liquidity, etc. You should also be given a clear procedure for addressing and resolving complaints. Be wary of any company that is unwilling to provide you in writing with the basic information that is needed to help you make an informed decision. Having done all of the required research and having made a decision to invest, you have additional responsibilities which you must embrace in order to protect yourself after you invest. Ensure that you keep files with all of the information in regard to your investment. Review your account statements and notify your investment company of any discrepancy. Pay attention to public announcements regarding mergers, tender offers, or other actions by third parties, and get professional advice before you agree to exchange or sell your shares. After having all this information about investment types and fraudulent schemes, we trust that you will invest wisely and not fall victim to scams. Remember, in order to purchase stocks on the stock exchange, you must do so through a broker. Here's a list of the 7 registered brokerage houses with which you may opt to do securities-related business. Remember, the only thing standing between a fraudster and your money is you. Don't be left holding your head in despair when you have invested your money with someone without having done the proper research and then you are unable to reach him. You have worked hard for your money. Take all the necessary measures to ensure it is safe and protected. Remember the simple rules. Ask questions. Beware of investment fraud. Check the SEC first. Thank you for participating in this, our first investor education webinar. Your feedback is important to us. Feel free to send an email with your comments and suggestions to investored@ttsec.org.tt. I hope you have a productive day and happy investing.